Resimac holding its AGM yesterday, reporting record home loan settlements for the first half. Management also sounding pretty bullish about the coming half of the calendar year. But obviously, there are challenges and risks ahead. Scott McWilliam is the CEO, and he joins us now live. Scott, really nice to see you there. Good morning to you. Look, home loan settlements up 72%. Have you ever seen a period like this before?
Well, no, it was a record period for us, so it's obviously very pleasing. And the bit that's kind of important in this message, it clearly demonstrates, the production of the company during, periods of kind of minimal disruption. So if you think about kind of the timing of flow, you generally, applications in one quarter will fuel your settlements in the following quarter. So, a strong period there, fourth quarter last year in applications flowing, through into this financial year, which is pleasing and supporting, the first half settlement numbers.
Have the peaks been seen though, Scott? Because we've got a big supply increase coming through across the capital cities. We've got talk of interest rate increases, APRA circling. What does it look like moving forward? Because as we were speaking with a few of our previous guests, competition in the space as well is extremely strong at the moment.
Yeah, look, it was a nice segue off you. I actually was fortunate enough to listen to the person before from William from Milford, and obviously then hearing what's happening with CBA today. So you're right, it is fiercely competitive. I've been in this part of financial services for 15 years, and I haven't seen it this competitive. That said, the amount of stock in the market is also at a record high, just in terms of home loan activity. What we're pleased to see is that, despite we're doing record settlement numbers, is we're also growing our book well above system, annualising kind of those first 4 months, it works out to about 15%. But as per your previous caller and what CBA and a few of the bank CEOs have called out is, NIMs are being squeezed in this particular environment. So for those that are actually in the fixed rate market, like for the banks, we're predominantly a variable rate provider in the market. But we're also seeing, the low margins from our front end book having an impact on our back end book, which is why we've just very much focused on growing AUM through this particular market.
Okay, so how do you do that, particularly if we do start to see interest rates rise? I mean, you've got to spend to grow.
Yeah, we do. And look, what we called out in that particular notice is actually where we are spending. When we reported our results for the full year, we're running a cost to income ratio between 30 and 40%, which is well below the bank. So we're a very efficient organisation, which allows us then to tap different channels. We've relaunched our homeloans.com.au brand in the direct channel, and we see that as a growth channel as consumers are just more and more comfortable dealing online, even with big ticket items like home loans. But the broker sector is particularly important, whether it's prime or non-conforming loans, because we actually offer a broad suite of products across the broker sector. We're still seeing strong demand, and some of these products are kind of counter-cyclical as well. So quite often the non-prime part of the market will grow when the prime market it softens. But even in a tightening cycle, and talking about monetary policy, even in a tightening cycle, we're still seeing we'll still see strong demand. It's a big market. It's a $400 billion a year market, and we're just coming off record low interest rates.
What about funding that loan growth that you're trying to go and achieve there? How is that looking at this stage? Because we've seen market rates going pull back, but then of course now starting to drift higher. How's that RMBS market looking at the moment?
Look, it is. No, it's a good point. So we are starting to see a normalisation of credit spreads. And we did a $1.5 billion non-conforming trade only last month. But to give you an indication of the demand in that market, we went to market with $1 billion trade and we ended up upsizing it to $1.5 billion. And that also had a US dollar shelf to it as well. So we're still seeing strong demand from overseas investors like we are from the domestic market. And we've got a lot of capacity in our system, whether it's, we have 7 different warehouse providers across our origination channel. And we've got plenty of capacity in there to write more business. And we're still seeing a lot of demand when we turn those warehouses out into the market. We still see strong growth even just under our current, funding runway as we see it today.
We know that term funding facilities also help to go and boost margins at the listed banks. Would you like to go and see if there's any more facilities like that in the future, access to more financial institutions rather than just the banks?
Absolutely. We would have loved to have borrowed money from the government, 3-year money at 10 basis points. But the fact is, why the banks were out of the market because they were tapping other facilities, and this was kind of government-supported facilities. And we saw credit spreads come in significantly during that period. We were issuing, as tight as 68 basis points over bills for, prime trades. They're margins that we haven't seen. Forget about the pandemic. They're margins we haven't seen since pre the GFC. Absolutely, and those facilities should be opened up to lenders that are out there that are trying to put credit in the market. So we'd like to think that would be considered, if the government is out there supporting markets again, because the non-bank sector is now becoming, a larger part of the market.
Yeah, just an interesting competition. Thought I'd go and throw it in there. Look, Scott, thanks for your time this morning. We'll speak soon.
Thanks, guys.